Welcome to the fourth episode of the DataSpot podcast. Interest rate is one of the most important variables in the economy. They affect everything from consumers to businesses to governments and financial markets. Interest rates in one country even impact people living outside that country. So interest rates are a big thing, and currently they are even bigger thing because they are going up quite sharply in almost every country. And the reason they are going up is inflation. Inflation is high in almost every country. Interest rates and inflation are thus joined at the hip. If we talk about inflation, then we have to talk about interest rates and vice versa. If we don't talk about the other, then it's almost as if it is a foul. So, in this episode, we will talk about interest rates. How does the central bank change interest rates? What is the mechanism through which a small 0.25% change in interest rate by the RBI in our case change the rate on home loans or car loans? Or if you are a businessman, the rate on your working capital loan. Therefore, without further ado, let us start with episode. Before we begin, some housekeeping stuff. In the world of financial markets, the unit of measuring interest rate is basis points, which is written as BPS, also called as BIPS. So, for example, if interest rates rise from 5% to 5.5%, we will generally say that the interest rates have increased by 50 basis points or 50 bips. Alternatively, we can say interest rates have increased by zero point 0.5 percentage points. We will normally not say that interest rate has increased by half a percent. That is just the convention. Okay, so let us first talk about why are inflation and interest rates so related. Part of the reason is of course theoretical. Interest rate as a tool is the most widely used and appropriate to deal with inflation. This is pretty much economics 101, and we do not want to discuss theory here, but there is a more important and practical reason for why interest rates and inflation are so connected. And that is that most central banks and central bank in any country that decides interest rates have an inflation mandate or inflation target. So if the central banks have a mandate to keep inflation in check, and if interest rate is the most common tool to modulate inflation, then it is but natural that inflation and interest rates are joined at the hip. The Bank of England has an inflation mandate, so has the ECB and the Federal Reserve. In India also, Reserve Bank of India has an inflation mandate, but it has a dual mandate of growth and inflation. But there is a hierarchy. Inflation control takes precedence over economic growth. But this was not always the case. India has only recently entered the inflation targeting regime. Here is Anisha who will tell us more about it.
Thanks, Swapnil. So, the way interest rates are set in India underwent a significant change in the year 2016. Prior to this change, the RBI had no specific or explicit inflation target. Of course, factors like inflation, economic growth, and exchange rate volatility were important considerations for monetary policy. But the RBI governor was free to interpret the importance of each of them as per his discretion. The inflation metric was also not defined. Sometimes the CPI would be used as the metric and sometimes the WPI. So, hypothetically, it was possible for the RBI to keep the interest rates low even if inflation was at 10%. Post the change, however, the RBI has now an explicit inflation target. It has to keep inflation around 4% with a band of plus or minus 2%. As long as inflation is within this range, the RBI is presumed to have met its inflation mandate. If inflation were to go above 6% or below 2% and remained there for 3 consecutive quarters, then the RBI is deemed to have failed in achieving its mandate, and the RBI governor has to write a letter to the finance minister explaining the situation. The other thing that changed in 2016 was the actual process of making the decision. Under the old regime, the RBI governor could take actions unilaterally. If his advisors told him that the interest rates need to be reduced, he was free to ignore their advice and raise the interest rates if that is what he believed was the best thing to be done. This committee consists of 6 members, 3 from the RBI, including the governor, and the 3 external members appointed by the government. Each member has an equal vote, and the decisions are made through a simple majority. So, it is possible now that the RBI governor is outvoted when it comes to setting the interest rate. Only in case of a tie, 3 on 3 on each side, does the RBI governor have a casting vote to break the tie. These new changes have given RBI a clear target of CPI inflation and also reduced discretionary power with the RBI governor to unilaterally decide on the interest rate policy. To be clear, this was done largely because having a less discretionary monetary policy framework is considered better and not because there were any insinuation that the discretionary power was being misused. The RBI has always been and continues to remain one of India's most credible regulator. With this, it is back to Swapnil.
Thanks, Anisha, for this. So, now we know why inflation and specifically the CPI inflation has become so much important in India in the recent years. So, how does the RBI saying interest rates will now be 6% and not 5% change the rate on your home loan? Does the RBI tell banks to increase home loan rates the moment it raises interest rates? Or do banks raise interest rates because they fear the RBI? It is definitely not the first. There is a little bit of second that is commonly referred to as moral suasion, but that is not very prevalent in the case of interest rates. Moral suasion works when RBI does not want banks to do something, like stop making risky loans or curb some aggressive sales practices, etc. The real reason why your home loan rate changes when RBI raises or reduces interest rate is liquidity. Effectively, what is happening when the RBI says it is increasing interest rates from 5% to say 6% is that it is also implicitly saying that it will change or adjust the supply of money such that the clearing price for money, which is the interest rate, increases from 5% to 6%. So, a change in interest rates by RBI also involves a change in supply of money, commonly referred to as liquidity. The RBI manages supply of money or liquidity through various tools like Liquidity Adjustment Facility or LAF, open market operations, and forex market interventions. You must have heard terms like repo rate, reverse repo rate, standing deposit facility rate, etc. These are all parts of LAF and are used by the RBI to keep the supply of money in sync with interest rate that it has set. For more on how RBI achieves this, it is over to Anisha.
Thanks, Swapnil. So, what does the RBI attempts to do is to keep the short-term money market interest rates, specifically the overnight call money rate, close to the policy rate it has set. The overnight call money rate is the rate at which banks borrow money from each other. So, if the RBI increases its policy rate by 50 basis points, it will reduce the supply of money or reduce the liquidity such that the money market rates and specifically the call money rate will rise by 50 basis points. So, the cost at which the banks will borrow or lend to each other will also increase by 50 basis points. This is how a change in interest rates by the RBI transmits to the banking system through an increase in the cost of funding of banks which are in deficits in funds and are borrowing money, and an increase in the return on funds in case of banks which have surplus and are lending to other banks. This relationship between RBI interest rate and the call rate, though, is not always one to one, and sometimes the call rate rise by less than and sometimes by more than the change in the RBI policy rate. Sometimes the RBI will want the money market rates to remain well below the policy rate, like what we had through the pandemic. But that is more an exception than the norm. The general framework is that the short term money market rates, and specifically the call money rate, will broadly move in sync with the policy rate set by the RBI. And if they do not, the RBI will take steps like increase in supply of money to make the two rates align. So, how does the RBI increase or decrease the supply of money? The RBI does this by offering more or less money under the various components of the liquidity adjustment facility, or by buying or selling the government bonds from or to the banks, or buying or selling the US dollars from or to the banks. The specific instrument it chooses varies. There are other tools the RBI uses to manage the liquidity and its interest rate objective, and some of them were deployed during the pandemic. We will do a separate episode on the various liquidity tools the RBI uses. But simplistically, this is broadly how the RBI manages liquidity or the supply of money. With this, it is back to Swapnil.
Thanks, Anisha. Now I get it. So, the policy rate is basically a signaling mechanism from the RBI to adjust supply of money. The RBI can very well achieve its objective of changing interest rates without changing policy rate, but by changing the supply of money. But the reverse cannot happen. It cannot achieve its interest rate objective by simply changing policy rates but not adjusting the supply of money. This is the key to understanding how interest rates actually change in an economy. As with price of biscuits or houses or mobile phones, the price of money, aka the interest rate, is also a function of demand and supply. Okay, so I know now what your next question is going to be. Anisha explained how change in interest rate by RBI affects the rate at which banks borrow from each other, and that too for a very short duration of a day. You still have not explained how this all links to my home loan or car loan. A home loan, after all, is a 10 or 20-year loan. Fair point. So let us talk about that now. First thing is that we have established the mechanism through which a change in interest rate by the RBI gets transmitted to the rate at which banks borrow from each other. So, if the RBI changes interest rate up or down, it will change the cost of funds or return on funds for banks. The change will not always be one to one, but there will be a change. If a bank with surplus funds can now earn 25 basis points more than before by lending to other banks, it will want other borrowers to also pay higher interest rate to lend to them. Similarly, if a bank can borrow from other banks at 25 basis points higher interest rate, it will be willing to pay a bit more than before to its depositors to raise funds. Effectively, a small change in interest rates by the RBI changes the marginal cost or return on funds for banks, and this change in marginal cost of funds will over a period of time transmit to all borrowers and depositors. Now, in the real world, there are other factors at work, such as term premium, which is higher the tenure of loan, higher the interest rate. And second one is risk premium. The riskier the loan, the higher the interest rate. But this is how simplistically a change in interest rate by the RBI impacts your home loan or car loan or working capital loan. It is broadly the same mechanism through which, if say the cost of raw materials or a car or a fan or television increases or decreases, it will eventually get reflected in the selling price. But there is one more way and a more direct way through which your interest rate changes. This happens in case your loan is on floating rate basis. In such a case, your rate of interest is directly linked to either an external rate of interest like the RBI's policy rate or something called as the marginal cost of funds based lending rate or MCLR, in which the rate on a loan is linked to the cost of funds of a bank. In both the cases, there is a one-to-one relationship between the underlying rate and the rate on your loan. If your loan is linked to the RBI's policy rate, even 1 bp change in the policy rate will result in corresponding change in your interest rate. And if your loan is based on MCLR, then any change in the rate at which your bank can borrow or raise funds will automatically change the rate on your loan. So let me wrap up. Policy rate is the signaling mechanism used by RBI to signal a change in supply of money. This change in supply of money impacts the cost of money for banks, and if the cost of funds for banks change, then it eventually reflects in higher or lower interest rate on our loans and also on our bank deposits. This has been a bit technical episode, but we hope we have been able to simplify it sufficiently. As we said during the podcast, we will do a separate episode on the specifics of how RBI manages liquidity and various tools at its disposal. In the next episode, however, we are going to deal with another elephant in the room, that is GDP. How GDP is calculated, what happens to GDP when you buy a new TV or ride an Uber. How does the statistical body make these calculations? Are you excited? Then you will have to wait for the next week. See you soon.
And that concludes this episode. I hope you liked it. Your hosts today were Swapnil and Anisha. The transcript of this episode and episode links are available on our website indiadatahub.com. If you did like this episode, please subscribe and share this with others who you think might be interested. If you have any feedback or suggestions as to what topics we should cover, do drop us a line at podcast@indiadatahub.com. See you next week. This is Ashutosh, the co-founder of India Data Hub, signing out.